All right, so today I wanted to do a video on small cap stocks. I am defining small cap stocks as being under 5 billion. Depending on who you talk to, the number will change a little bit because there's no set in stone definition of small cap, mid cap, large cap. First things first, if you get value out of this video, please like and subscribe. Really appreciate that. So first up on the list here, let's get right into it, is EQ Bank. Obviously, I really like this company. I've talked a lot about it before, and it makes me really happy to know that the majority of my position in it was bought below $50 a share. My average position, I think I'm up even almost 100%. So very much love EQ Bank, and I think it's probably about fair value where it's at right now. I think the last time I dug into it, my fair value was like 110, maybe 115, and it's just below 110 right now. So I think it's about fair value. It still has a PE below 10. So as much as it's ran up over the last year or so, I still don't think it's overvalued. I'm not necessarily head over heels if I didn't have a position in it to get in it right now, but I really still do like it. It has almost everything I like to see. I mean, look at its dividend here. It's growing. I mean, over the last 3 years, 36%. Over the last 10 years, 18%, and the payout ratio is still below 20%. It's at 15.8%. So the dividend's growing extremely well. If we look at its numbers here, if we look at revenue, again, revenue is going up basically every single quarter, to be honest, which is phenomenal. If we look at earnings is also not going up 100% of the time, but it's a very clear step upwards. And something I also just noticed is their shares outstanding actually went down ever so slightly over the last quarter at least. So that's something that I've said time and time again. This is honestly one of my only criticisms is I don't know why they're issuing shares. I mean, they have an earnings yield of like 10%. I think it might even be higher than that. Yeah, almost 11%. Like I have absolutely no idea why they're issuing shares when they're that profitable. But again, I've never managed a multi-billion-dollar company, so who am I to criticize? But honestly, of all the ones on the list, this is definitely one of, if not my favorite. And if you don't have a position, I would definitely be looking to get into it on pullbacks. The next one is Powell Industries. This is one I have on a watch list I would like to get into, but I just think it's too expensive where it's at right now. A PE of 25, a price to free cash flow of 18. From the outside looking in, that doesn't appear expensive, but this is not a company that typically trades at a high premium, so I'm definitely not super head over heels. And I mean, if we look at this company, I mean, over the last 5 years, I mean, it was a $39 stock 5 years ago. It's up over 600% in the last 5 years. So this stock has done extremely well. I mean, just over the last year, it is up probably a couple 100% as well. I mean, this was a $80 stock at one point. It's up 261% from its lows back in January. So it's done extremely well. I would like to take a position, but I just think it's too expensive where it's at right now. But I think it's a really good company. It's in a really good industry, and that's basically why I like it. So that is Powell Industries. The next one is HWKN. This is Hawkins. Another one that I really like that I just think is too expensive where it's at right now. I've had this on a watch list for probably almost a year now, to be honest. This is in the chemicals space. A PE of 31, a price to free cash flow of 31. Those are both just too expensive. I'm looking for it to come down probably 10 or 15% before I would get interested. But I really do think this is a really good company. And I mean, we look at its metrics here. I mean, earnings yield a little over 3%. Obviously, I'd like that to be a little higher, but given how well it's growing, I still think that it's not that bad. We look at its revenue. It's kind of actually plateaued over the last almost 2 years. But if we go back to its earnings here, earnings has continued. In fact, earnings is just a consistent stair-step higher. So that's something that I really like to see. I mean, back in going into 2019, it was actually negative when it came to earnings. So that's why I really, really like this company. They're not even issuing shares. In fact, their shares outstanding have actually gone down slightly. So companies that can grow organically without having to issue shares, especially and take on excess debt, especially the smaller cap names that typically have more trouble growing, that's what I really like to see. And not to mention too, they only have $246 million of liabilities on $2.6 billion market cap. That's another thing I really like to see with any company, is not having excess debt, because it's looking like we're going to see a higher rate environment going forward, and companies that carry a lot of debt or excess debt are going to get hit harder. It's going to be harder for them to survive. So that's something I definitely keep an eye out for. The next one is NSSC, and this is one I've owned in the past. I did sell it basically near its highs, mainly because this company is just really hard to get a reading on. There's certain things that make it look like it's just absolutely insanely good, but then there's other things that's like, okay, well, if this company's so good, why is it down on the year? Like that just doesn't make sense. So, I mean, if we look at its revenue, it's consistently gone up over time. If we look at earnings, also has gone up nicely, although it's trended back down a little bit. So there's a lot of things that look really, really, really good with this company. But then, to me, it just seems like it's too much of a coincidence that it's like, if they're so good, I mean, the current ratio is almost 7, so they have virtually no debts, which is just crazy good. They're hardly even issuing shares. Earnings and revenue are projected to be up a lot next year. I don't know why this company is down. Like, every single thing that you see from the outside looking in shows that this company should be up, especially when you've had such a bullish year for the stock market. So one thing when it comes to stocks, at least for me personally, is I don't like having to spend hours and hours researching companies. Like, some people might call that lazy or whatever, but personally, I want to be able to look at all the charts, be able to read up a little bit, obviously, because most of these companies, I do read like the basic earnings reports, but I don't listen to the full earnings call for virtually every company. I don't look into the company, like reading all the prospectuses and all that kind of stuff. Like I probably do have the time to do some of them, but to me, if you have to do all of that stuff, is it really worth it? Like, is it really worth it? Because there's a lot of companies out there, like EQB. Like, do you really have to spend tens of hours looking into it to know if it's a good company? Visa, Nvidia, Apple, Amazon, like the list goes on and on. Do you really have to look into them that much? Like, obviously, it helps to look into them. It can confirm your hunches, but for a company like this, I'm kind of talking in circles here, but it just makes no sense that you can look so good from the outside looking in and yet still have performed so poorly. So that's the reason that I do not own it, but I do have it on a watch list nonetheless. And I think this definitely is more of a high risk, high reward play. The next one is Go Easy. This is another one I've talked about quite a bit before. I really like this company. Obviously, I think government regulation, I think they could potentially go after a company like this, but at the end of the day, they're doing so well. Like, they're below their historical averages. So this is one that I think you probably is if anything, it's a little bit below fair value where it's at right now. If you look at revenue here, I mean, just a consistent stair step higher, which is exactly what you like to see. They are diluting a little bit, but I mean, it's nothing crazy significant or even significant at all. And then if we look at earnings, I mean, they had one quarter here, first quarter of 2021, where they were absolutely insane. I don't know what happened there, but it's still trending higher. Like, it's still clearly trending higher. So I really like this company. I do have a full position, so I'm not really buying any more, but in my mock portfolio, I did buy it recently when it went down below 170. I did take a position there. So that's, if you are looking to pick it up, I think it is slightly undervalued. And if it goes lower, I definitely think it's even more undervalued. Like, I think fair value for this is probably like 180, 190. So I definitely think it's a little bit undervalued. They're growing their dividend extremely, extremely well. I mean, 2.7%. The payout ratio is 27. They're growing at 21% per year. I definitely really like this company. The next one is ALG. This is another one I have on a watch list. Have never owned it before. They provide like a lot of machinery and stuff for like government vehicles and stuff like that. Agricultural equipment, infrastructure maintenance equipment for government and industrial use. So pretty much what I thought. And if we look at their free cash flow yield is 6.6%. So they're really profitable. That's exactly what I like to see. They're growing their dividend extremely well. If we go into their income statement, revenue is growing nicely. It actually has plateaued a little bit over the last year and a half or so, but I'm not overly concerned there. If we look at shares outstanding are basically flat. Earnings is actually trending down a little bit, so I'm a little bit concerned there. But they're still projected to grow earnings, like I think it's like 12% over the next 5 years or something like that, or 10 years. So I'm not concerned. I think this is more of a temporary thing. I'm not buying it right now necessarily. I still think it's a little bit more expensive than I would want to pay, even though it is below its historical averages. I'm still waiting for it to come down a little bit. I think I haven't ran a full DCF on this company yet, to be honest, but I'm still waiting for it to come down a little bit more. It is basically between its median or average on the 52 week. It looks like it's pulled back actually a couple times over the last, actually several times over the last 6 months into the 160s. So that's probably where I would look to pick it up if you could get it below 170, just bird's eye view here. And then the last one here is SNPS. This is actually, no, sorry, it's SPNS, not SNPS. Sapiens International. So this is kind of an interesting company here. $1.56 billion. It provides software solutions for the insurance industry. And something that I noticed here is this company actually trended up fairly consistently up until last week. So I'm guessing they released bad earnings. They're actually down 31% since then. And a lot of people are probably like, oh, are you buying? Are you buying? Are you buying? And honestly, no. I'm still waiting for it to come down a little bit more. I think fair value is probably like 24, 25 here. So probably another, 10% or so. But honestly, this is a company that I just discovered. Also have not run a DCF on it yet. So I don't know exactly where my buy point would be. It is below all of its historical averages, but it is still trading at a slight premium to the market. So that's something I would have to dig into a little bit deeper. They're projected to grow nicely in the future. They don't really have a lot of debt. The 5-year returns are below the S&P by quite a bit. So that's something that's definitely concerning. This is another one, again, would require a little bit more research. But, I mean, look at the revenue here. The revenue's grown extremely nicely. If we look at earnings, has also grown quite nicely over time. They are issuing a small amount of shares, but typically when you look at stocks, the share price will follow the earnings. Like the share price follows the earnings. So even though it's down quite a bit recently, if you look at this number, if you keep looking at this number and it continues to trend up, well, the share price will follow eventually. So this is another one I have on a watch list. I will buy if the price is right. Like if it continues growing the way it's growing, I definitely will buy. Like if you can get it for like a 20, 21 PE, yeah, I'm probably going to buy it. So this is one, like I said, I just noticed. I don't like diving in head first into companies, especially when the market's at an all-time high. So this is one I definitely will have to look into a little bit further, but I do have it on the watch list. So that is small cap stocks. Honestly, of the ones out there right now, the only one that I think is for sure a buy right now is Go Easy. All of the other ones I think are probably you're going to wait for a little bit of a pullback, which is expected when you have markets at basically an all-time high. So anyway, if you liked the video, please like and subscribe. Really appreciate that, and stay tuned for more.